You've likely heard the importance of generating solid returns and prudently spending, but you may not have been told, probably haven't been told, about the key to truly safeguarding your retirement. We'll discuss it today. So as Matt hit cut after that intro, I realized I must have had the melody of Rudolph the Red-Nosed Reindeer running through my head. Such is my life with a bunch of little kids running in our house during the holiday season. But in all sincerity, you know a whole bunch of different ways that you've been told to safeguard your retirement, but you probably don't know the greatest one of all, and that's reducing volatility. So what I want to take you through today is how that proverbial 7% return that not only has been the 30-year average of most diversified portfolios, and even the S&P 500 over the last 20 years isn't really the key to your retirement, but how reducing volatility brings other benefits, from improved certainty, improving the experience that you'll have as an investor, and finally, and most importantly, extending the longevity of your portfolio. So I know this is a brutal chart, but hopefully rather than skip ahead, you'll stay with me. Really what we're looking at is three just kind of sample portfolios based off different amounts of the S&P 500, international stocks and bonds in equal weighting, from 85% stocks, the rest bonds, 70, and then 65, representing, for the purposes of this conversation, a high volatility portfolio and a low volatility portfolio. So what you see here, first column, in this beautiful purple, is the 30-year returns for those portfolios. This in and of itself is perhaps one of those surprising factoids most people don't know, which is it isn't the allocation that really changes the overall return all that much. For all the ups and downs and heartache, we all end up in about the same place if you stick with it. And as you can see here, for these three portfolios, it isn't that return that's the distinguishing feature. It's the second column, the volatility. How much volatility are those portfolios going to experience as measured by standard deviation? That's another boring video for another day. But from a high of 12.6 down to a low of 8.8. This is what's going to drive the rest of this discussion around, again, how to improve clarity, experience, and the longevity of your portfolio. So benefit number one, improving clarity. Just like Matt's making me reshoot this video because I wasn't that clear the first two versions of it. Lowering volatility decreases your chance statistically through various simulations of failure. A failure would be a simulated sub 3% rate of return over a 30-year time frame. If you look at the probability of that happening within a high vol portfolio, it's actually a high of 10%. Mids right around a 6%, with a low vol portfolio just a little bit above 3. So again, minimizing as best we can the chances of some type of a tail event within your plan, all while, as you may recall from my purple numbers there, getting over the long time likely a similar rate of return. Point number two, improving the client experience. Look, this is certainly about math. We talk about this all with clients, even our new tech we've been rolling out to help extend that client experience. Yeah, things have got to be made right by math, and we objectively walk through that with clients and have something in there for them. It also needs to work on an emotional level, that interplay between theoretical money management and practical money management. We spend a ton of time on both, but really emphasizing the latter to help people understand how this is going to impact their day-to-day life, right? And this is this volatility conversation. If you look at volatility and how people have experienced it, and you've been watching these videos for a while, you'll recall that the same part of your brain that gets triggered by mortal danger gets triggered by losing money. We don't like it. None of us do. We're hardwired, if you will, to be bad investors. So how do we improve the odds that we can stay the course emotionally? Reducing that volatility. If we want to define, and for purposes of this video we are, a bad month as a drop of 5% in our portfolios, the odds of that happening within a high vol portfolio historically are right around 8%. It's going to happen with some regularity, probably about once a year on that proverbial monthly statement. By contrast, a low vol portfolio, it's only going to happen about 2.5% of the time. So, 75% less chance of that happening, helping you, again, not only be able to afford your retirement, but hopefully enjoy it a lot more, through reduced volatility. Finally, improving the outcome through the longevity of the portfolio. Again, through all these different permutations, and we've done this with a number of different companies, what you find is you can add about 25% in terms of years from a low of 23 with a high vol portfolio, upwards of 30 with a low vol portfolio in retirement, and also increase your distribution rate by about 33% as well. So again, that longevity that people are looking for, am I going to be okay even in the midst and teeth of the nastiest bear market? In conclusion, this is not, as Nothing We Do is, an anti-asset class video, i.e. we're not certainly against stocks. They make up, again, for most people, the benefit of the portfolio. It is about maximizing risk return. What we see a lot of times is people taking unnecessary risk, being unaware of the risk in their portfolio, and as we discussed today, really how that can impact their portfolio through retirement. We've got ways to walk through that, show you, pop the hood, if you will, on your portfolio as a client or as a potential client, and happy to do so anytime. It's also, and we didn't even get into this would be getting really down into the weeds, but this can be optimized even further through the use of alternatives, income producing strategies to, again, push out that longevity of a portfolio almost indefinitely in some case. At the end of the day, why this is so important to me, why we keep banging on this drum is, we had a huge year of growth here at 10 Capital. Lots of friends and colleagues introducing people, and what we see time and time again is ill-constructed portfolios from a risk-adjusted return standpoint, ill-conceived plans, and here we sit, markets at an all-time high, yields at an all-time low, and the record amount of boomers heading into retirement. To me, it's a perfect storm. We want to help as many people as we can and encourage people to, again, recognize their limits, both financially and emotionally. And it's a journey we certainly enjoy and would welcome the opportunity to walk with so many of you. With that, thanks so much, and we'll see you soon.